If you've read the news recently, you might be wondering, what the heck is Trump doing? Grab your snacks because you're about to be here for a while. Since assuming the Oval Office, Donald Trump threatened tariffs against both his allies and his foes. And he did it. He imposed tariffs on key trading partners like Mexico, Canada, and China. Yes, China. Despite the animosity between the two nations, trade between Washington and Beijing is estimated to be roughly $600 billion per year. Now, for those who still don't know how tariffs work, I've got you covered. To facilitate the explanation, let's take two random nations, say Vietnam and Cambodia. For example, suppose the Vietnamese president, for some reason, decides to impose a 25% tariff on goods imported from Cambodia. With tariffs in effect, when Cambodian goods arrive at the Vietnamese border, the importing company or individual is required to pay the extra tariff in order for those goods to enter Vietnam. What happens next is that the importer must decide whether to absorb this additional fee as a loss or pass it on to consumers through a price increase. Ultimately, the parties most affected in this hypothetical scenario are Vietnamese importers and consumers. Returning to our main point, the US, under Trump, imposed tariffs on key trading partners and even threatened Europe with tariffs. But let's take a look at how a full-blown trade war would come into play. A trade war between the United States and its key trading partners, Canada and Mexico and China, would have profound economic, political, and strategic repercussions for the US. The United States heavily depends on imports from Canada and Mexico for energy, raw materials, and auto parts. For example, approximately 60% of US crude oil and a significant portion of natural gas are imported from Canada. A 25% tariff on these energy products would force the US to source them from more expensive domestic or alternative foreign suppliers, resulting in higher fuel prices nationwide. Similarly, Canadian softwood lumber, integral to US construction, could see prices surge by up to 25%, directly impacting housing and infrastructure costs. In the automotive sector, nearly 40% of US auto parts are sourced from Canada and Mexico. A 25% tariff in these categories could escalate production costs and ultimately raise vehicle prices by 10 to 15% across the board. In addition, China supplies a wide range of consumer electronics, apparel, and household goods to the US. With tariffs potentially rising from an initial 10% to 20%, the cost of everyday items like smartphones, laptops, and clothing could increase by 10 to 20%. Thereby aggravating the pressure on American consumers. Studies have estimated that such tariff measures could add over $1,200 annually to the cost burden of an average US household. The deep integration of North American supply chains mean that halting trade with Canada and Mexico will have cascading effects through US manufacturing. The automotive industry, which relies on just-in-time delivery of auto parts from these nations, would face production delays and increased operational costs. This could lead to a decrease in the overall output of the US manufacturing sector, potentially reducing US GDP by 0.1 to 0.2% for each major trading partner affected. Meanwhile, US exports, primarily machinery, vehicles, and agricultural products, would likely drop by 10 to 15%, exacerbating the trade imbalance. Similarly, a halt in trade with China would disrupt the supply of intermediate goods crucial to US production. US manufacturers depend on Chinese components to maintain competitive production cycles, and losing access to these could force companies to reconfigure their supply chains at higher costs. This configuration, combined with the direct tariff-induced cost increases, would not only diminish manufacturing output, but also lead to broader economic contraction and job losses across various sectors. Of course, targeted nations are unlikely to sit idly by. A US-initiated trade war would almost certainly provoke retaliatory tariffs from Canada, Mexico, China, and the EU. For instance, if Canada and Mexico respond with their own 25% tariffs on US exports, US products in sectors such as agriculture and automotive could lose significant market share. Furthermore, such aggressive unilateral measures could weaken long-standing alliances and drive US partners to diversify their trade relationships away from America. As investors and companies stray from the destabilized American market, they may seek stronger, more secure alternative economies, potentially giving strategic gains to major nations like China and India, further consolidating their economic presence on the global stage. Retaliation might not be solely economic. It could spill into politics. Imposing such tariffs on allies is a dangerous gamble that might not be as rewarding as expected. Sentiment toward the US would begin to diminish, trust would erode, and these allies might come to view the United States for what it really is: a bully. This could ultimately lead to the emergence of new alliances as nations seek partners that will not backstab them.